Hey guys, welcome back. I hope everyone had a good week. So here's what the plan is for today. Just going to do a quick intro into AIM for those that haven't. I just want to introduce it a little bit better. We'll do a screen record and go through that. We're going to go over the three financial statements, income statement being one, and then also we're going to go over the type of accounts because this is the key. This is where it gets really confusing, right? Is knowing the accounts. And we'll go through that. We'll go through the statement of owner's equity, what that is, and then we're going to go through the balance sheet. Okay, so let's get into that. Also, just as a quick reminder, if you want to subscribe and then click on the little notifications bell, so when videos come up, you get notifications right away, and the communication is quick and timely. Okay. So we're going to go through intro to AIM. So I'm going to do a screen record just right after this video. Textbook location, where we're starting for chapter 2, so you understand, you don't get confused, because there's a lot on the home page. We're going to talk about flip learning in a minute, and then we're going to continue on and talk about what the process should be. So you should be reading the chapters first and then doing the tutorials. A lot of people don't read the chapters in the textbook. They just jump right to the tutorials. That you will find more challenging if you do that, because you'll have come up with problems and questions. So you want to start a solid foundation. So absolutely, please read the chapters first, then do the tutorials, right? So chapters first in the textbook, then do the tutorials, okay? And at the end of the day, it's going to take time because, like I mentioned up in here, the difficulty is not the accounting portion of it. It is the terminology used. And you'll see that as you go through, understanding different terminology. And that'll be explained when we start talking about the counts. And I'll give you some tips and reminders that makes life a little bit easier when you go through it, okay? And then at the end of the day, we're going to practice, because that's the only way to do it. It's not like a trick where you just learn the trick and then you're good to go. But it's practice doing it over and over so you learn to use the terminology accordingly. Okay, so let's jump to the screen video now. So here is what when you log into AIM, you should look like. It'll actually, before the screen, it logs into your class. And then you're right into it. It's pretty straightforward. There is a tutorial and all this. If you guys start to do the tutorial first, you might find it a little confusing, but don't get frustrated. By all means, if you want to get into it, I wouldn't recommend it right away. I think it's too much. But if you want, it's there. Your textbooks, there's your two versions. It's KP or MAP, whichever format you want to download it into. But that is where your digital textbook will preside. And as we scroll down, where we will be beginning is chapter 2. When we're talking about tutorials, make sure you read it correctly and you follow the instructions, what I'm talking about in the modules. Remember, I talked about week 2 modules. I don't talk about doing the post-class homework right away. I don't talk about doing the quizzes. You by all means can start those, but you will struggle if you haven't, if you get ahead of the class. So after today's class, if you think, oh, I'm going to do the quiz and the post-class homework, you're going to challenge. So please be patient with that, okay? So these are the tutorials that I'm asking you to do today, all right? And then we'll be spending the next 2 to 3 weeks on chapter 2. So be patient. This isn't just a one class and then we move on to chapter 3. There's a lot. We're going to take our time going through this because you will find it challenging, especially if you jump right ahead into the post-class homework, all right? So yeah, so that's a quick little workbook. There's also some additional resources for you to work on if you want, again, to practice. That's there as well. And then it just keeps moving on to chapter 3 and 4 and so forth. But I just wanted to get everyone familiar. This is what you're looking for. This is where your textbook is. And then we're starting into chapter 2 tutorials only, right? Yeah, if you have any questions, if you have any challenges logging into AIM, go up to the top or go actually to the page prior. You can click on the help. And down here in just over here, there's a contact us, and you can actually email them if you have any challenges as well. Okay, I can't access AIM. I can't access your AIM. Just also keep in mind is that when you guys are sending me questions about questions in AIM, the challenge is I don't see the exact same question. So AIM, if your fellow student is working through it as well, they're seeing different questions. AIM is set up to be different for everybody. The questions are basically the same. They just change the wording a little bit and the numbers a little bit. So the question essentially is the same, but they change the names and the wording. But you basically get to the same point. But they're not exactly the same. I just want to give you a heads up. So when you say to me, question 2, we're having troubles, I don't know what your question 2 looks like because it could be completely different from somebody else. All right? Everyone understand that? So when you say question 2, it means nothing to me. So if you have questions or concerns as you're going through, do screenshots and then send them to me, and that makes my life a little bit easier, helping you through. I can get you where you need to be faster. All right? Perfect. So let's move on. Okay, so let's look at the 3 financial statements. Okay, so the first one, and this is important when you're talking about, there are many financial statements, but the 3 that we're going to be focusing on is the income statement, statement of owner's equity, and the last one is balance sheet. Okay, this is crucial. They need to be done in this order. So that you can pull information from each one as you go through, because the statement of owner's equity requires numbers from the income statement, just as the balance sheet requires numbers from the statement of owner's equity, and we'll get through that, okay? So it's important when you're going through that they get done in that order, right? Income statement first, statement of owner's equity second, and third is the balance sheet, okay? When you're going through AIM, you might find they jump around and they get through that a little faster, but I need you to kind of stick that in the back of your brain because it'll become more important later. All right, so let's look at an income statement. So here we have 2 charts showing personal accounting versus business accounting. We are going to be focusing on business accounting, obviously, but understanding that it's very similar, and to understand that sometimes there are similarities, but there's also difference, and it sometimes just comes down to the terminology. Again, falling back on that, it sometimes can get confusing. So let's think about what should be an income statement, and well, it needs to be income, right? So income is how much money you make, or how much business the business makes, how much money the business makes. So when we get into terms of accounting, again, here we go, getting the terms, it's known as revenue. So service revenue is one of the terminologies that we use on the income statement. And then afterwards, we minus all the expenses, right? At the end of the day, we want to know how much income or how much revenue the company has made. So the formula generally is income, how much revenue you actually make, right? Service revenue, so you're applying a service, minus all the expenses. So depreciation, insurance, rent, any other expenses that would fall under that category and or accounts would be minused out of that. So you would end up sometimes either with a net income in a positive or a net loss. And that's why it's important to understand the issues of what's happening in an income statement. So an income statement, again, right, it's just a place to record all the revenue and expenses that are occurring during the business over a certain time frame. Okay, so let's look at some of the accounts now. Here are a few of the accounts. So let's break it down. So on an income statement, we're looking at revenue minus expenses, right, equals either a net profit or net income or a net loss, right? So let's look at revenue, right? Ways to generate money. How can we generate money? Well, the first one is we can sell our services, right? For cutting grass, we're hosting an event. It's a service, so we generate money from that. People pay us through that. Second one could be rent revenue. So if we own something and we want to rent it out, if we're renting out a piece of property, a vehicle, whatever that may be, we get revenue or get paid for that, right? Also interest revenue if we're investing on something. So if we invested in stocks or we invested into another company, we would get income from that. So interest revenue. So all these ways that a company can generate revenue or money, right, would fall under one of these 3 categories. And there's a few others, but these are the 3 biggies that you'll come across in AIM. All right, so let's move on to expenses. So and there are many, many expenses. By all means, these are just a few, but these are some of the key ones that you'll come across in AIM. So bank fees. So what would be bank fees? So bank charges, right? Remember when you use your debit card or your transferring fees, sometimes there's a bank charges you fees for using your card, right? Advertising, obviously, whatever that may be, whether it be on social media or print or what have you, there's a cost associated with it. If you have a social media person running your social media account, you have to pay them. That sometimes would fall under advertising, depending on how it's built. Meals and entertainment. If you're entertaining a guest or a customer who, maybe you'll have a long-term contract with, depending on who it is, that would be an expense that you would occur to the business, not you personally, right? Remember, we talked about the different types of ownership. We want to make sure everything that we do for the business falls under the business accounts. It doesn't fall under you personally, okay? Repairs and maintenance. Sounds exactly like that. If you have a building and you have a leaky roof and you need to do the repairs on that. If you have a vehicle that's part of the business and you need to do repairs and maintenance on that. Anything that could fall under that category would go under repairs and maintenance as an expense, right? So all these things taking away from your revenue, right? Keep that in mind. All right, so moving on, travel. So if you're traveling for business, that would fall into that category. Rent expense. So maybe you don't own the property. Maybe you are renting it from someone, landlord who owns the building in place. So you'd have rent expense. That on top of that, maybe an interest expense. So if you were to put something on your Visa and you're getting charged interest on a monthly, that would be an interest expense, right? Those sort of things on top and beyond that would take away from your revenue. All right. And last but not least, I mean, the obvious one is office expenses. So pens, papers, computers, all that kind of stuff that would fall under office expense, all get taken away from your revenue. Okay. And again, it's just once you get into knowing the terminology, it'll start flowing a little bit faster and easier for everyone. All right. So revenue minus expenses gets you a net income or a net loss, depending on after you minus these out. Is it a positive, right? Or a negative, which would give you a net loss. All right, so let's move on. So here's another formula, right? Income statement, revenue minus expenses gives you either a net income or a net loss. And here's the formula down here, okay? So write that down, put it in your brain, stick it away. Just as a good little tip to write that down, as long as you understand it, because that is something that will obviously come up in a test, but you'll need to understand how it's generated, all right? Okay, so the next statement, number 2, right? Statement of owner's equity. Okay, so statement of owner's equity is the formal statement to show how much the owner's equity has changed during the month, right? Has it gone up or has it gone down? So at the end of the day, if you need to liquidate your company, how much is it worth, right? It changes depending on what has happened during that period. Whether you incurred more expenses or more revenue, it would change. So we need to look at that. So let's do that now. So let's look at some of the accounts that you're going to see on the statement of owner's equity. So you have opening capital, right? So it's the starting capital already in the company. It would come from the previous month, right? So that would be examples of cash or vehicles that are actually owned by the company, and that is known as OC, or opening capital, right? The next would be capital. So the money or vehicles that are invested into the company for that period month. So that's why it's important to understand the difference. So previous month, current month, okay? And unless it states opening equity, assume that it is 0, okay? The next one, we're going to skip around from net income and net loss. Where do we get those from? Right, we mentioned they come from the income statement. That's why it's important that we mentioned before that you do the income statement first, all right? So that's taken from there. But let's move to the next one. Drawings. So drawings is monies that are taking out for personal use. So for example, say I own a bicycle shop, and then all of a sudden I find out, hey, my kids need new soccer cleats because they just joined the soccer team, and now I don't have any money, so I need some money. So I would go take it from, or withdraw it from the company, and go buy the soccer shoes. But I've used it for my own personal use, okay? So it's withdrawals, or also known as drawings, okay? So for this case, to keep it consistent with AIM, we're going to know it as drawings, okay? The D. And last but not least, and we just mentioned it earlier, is net loss. Again, taken from the income statement, remember? Because there's either a net income or a net loss. One of the two. You can't be both, right? Either you're making money or you're losing money, all right? So at the end of the day, here's the formula across the bottom, right? So opening capital plus net income minus drawings minus net loss equals ending owner's equity or capital. It's depending on where you read it, but for now we'll try and keep it consistent with AIM. So ending owner's equity. Excuse me. So that's a good little formula to remember that as you're going through. So that's another formula to keep, write it down somewhere so you have it written down for reference when you're doing the tutorials or the in-class assignments. All right, perfect. Let's move on. So let's look at an actual statement of owner's equity, right? So some key points to look at. First of all, needs has have the name of the company, right? It's an actual formal statement, so it needs to start with the name of the company. Then what kind of statement is it? Is it an income statement? Is it a balance sheet? What is it? So it's a statement of owner's equity, so that needs to be there. And again, it has to have a date, right? This is for the month, so it's recording it, the statement, and how it changes month to month, right? So that needs to be there. And let's look at it. So first one is their capital as of March 1st, right? Because this, look at the date, it's ending March 31st, so for the month, so it's from the previous month. So was there any opening capital for the first of the month from the opening capital? No, it's zero, right? And then what happened? The owner or someone invested $30,000, right? That came in. So again, so now you have capital because it was invested, right? So now you have opening capital plus capital plus the next one is net income. So if they made money, and how did they make money? Yeah, they made $9,400, right? And then what happened? Was there withdrawal? Yes. So there was a drawing of and actually in the formula it says W. So again, it may jump back and forth, but keep in mind it means the exact same thing. So in this formula, I actually noticed I left W in there, but it could be a D or a W. Both are correct. Withdrawal for something, and it was amount of $2,000. Was there a net loss? No, it doesn't show it on the income, so because they actually made money, right? You can't have both. You can't have a net income and a net loss. So it's one or the other, right? So obviously they made money, so they would have no net loss. And at the end of the day, they end up with their statement of owner's equity. All right. So it's important to kind of understand the flow of things and how it goes through. And again, just remembering the formula and just remember that the W and the D, right? Withdrawal and drawings mean the exact same thing. All right. All right. Let's move on. So let's go through an example. So here's something that you would see. And again, it gets into terminology, right? So let's go through what happened during the 1 year. Okay, so this is a time frame. So this being a month, they looked at a 1 year time frame. So you, as an owner, contributed $20,000 cash to start up your business. So what does that fall under? Right? So it would get logged as $20,000, right? So step one, as you can see right here, they've numbered it, right? So you contribute cash, and what did you do with the cash? Well, you just didn't throw it to the company. Where does it actually go? Well, it actually goes to the bank, and they call it cash. So another terminology I want you guys to get used to is cash. When we're talking about cash, it's in the bank. Because if you think of where the cash is, it's in the bank, right? So if you need to withdraw cash or from the bank, right? So you're drawing it from the same. So cash and bank are the same thing. It's a good way to kind of remember it so that, if you have the physical cash, where does it go? And even nowadays where you physically don't have cash, where is it kept? It goes into your bank account, right? So it's kept at the bank. So we always keep that reminder there. So we invested the money. It didn't have an opening balance. It had an opening balance of zero because it's a startup company, because it says right there, it says startup, first year running, so it would have zero starting. And then we invested $20,000, okay? And then you withdrew a drawing of $1,000 cash from the business, right? So where do we get the cash? We need cash. We took it out of the bank, right? Out of cash. So there's number two. You can see right there, they label it, so you can match it up, one and then two. But they took it out. So now your cash balance or your bank balance is $19,000, okay? And then if you look at what was your net income for the year, you earned, so keywords, you earned, right? You earned money, a net income of worth $5,000, right? So if you look at the drawings minus the opening balance, right, from the previous year, you'll see the net income is $5,000, right? Because remember the formula. So if you go through the formula and you can figure it out, so opening capital, right, plus capital, plus net either income, right, net income, and don't mix them up, don't substitute them in because you'll get confused, because what will end up happening, you'll go plus net income, and then you'll say, oh, it's a net loss, so that you'll stick it there. So just kind of add in the numbers, right? So opening capital plus net income, which we know because it came from the income statement. So they made $5,000. Did we withdraw money? Yes. So it's a minus, right? We took out $1,000. And was there a net loss? No, because we had a net income. So the net loss is zero. Gives you your owner's equity. All right. So this, again, the tricky part is this when you're understanding the terminology. Okay. So the practice, and you'll become more and more familiar with it. So don't get frustrated. It's not something you learn right away, but it will slowly come as you start learning the terminology. Okay. Okay. Let's move on. So last but not least, the balance sheet, right? So this is the last of the three financial statements that are going to be going through today. So let's look at one here. So just like we talked about in the statement of owner's equity, it must have a company name because we need to know. Remember, this is a formal statement that gets submitted either to banks or accountants or what have you. So it has to be formal. So everything has to be there. You can't just assume. So it needs to have a company's name. The title, what is it? Is it the balance sheet? Is the income statement? What is it that you're laying out there? And it gives you as of a certain date. So as of March 31st, this is what the balance for the companies is, right? And a balance sheet basically looks at the amount of assets, so how much you have, versus what you owe, liabilities, okay? Keyword, liabilities, right? Knowing what you owe versus what you have. So you can have $5,000, right, in cash in your bank account, and also in furniture and cars and whatever you physically have, versus what you owe. So it's very possible, and a lot of people out there fall into this category, running poor business. You actually owe more than what you have, right? So it's kind of one of these things, right? So you owe, so you're not, they talk about that balance, it's kind of off balance and the company's not being successful. Obviously you want to owe more than what, or have more than what you owe, and ideally you have a better company, right? So when we look at the formula, so on a balance sheet, assets equals liabilities, right, plus owner's equity will give you how much your assets are. All right. And where do we get the owner's equity? That's right. We get it from the statement of owner's equity. That's why we need to do balance sheet last, because we're going to need that number. All right. So let's look at some of the accounts. So the first thing we're going to look at is assets, okay? Because there are tons of things you can own, right? So I mentioned in the previous slide that banks and cash are basically the same thing, right? Because they keep it in the. So when you're hearing the terminology, you need to make the association that cash and bank are the same thing. All right. The next most popular one that's going to come up is for accounts on the balance sheet is accounts receivable, AR, right? So if customers owe us money, so a lot of times we do a job and they owe us money. We'd send an invoice and they owe us money. So that's in there because we still, even though they haven't physically paid it, we know that it's got to come to us, okay? So accounts receivable, so AR, customers owe us money, right? That's a little tricky one. Prepaid accounts, okay? So maybe you prepaid your rent. So maybe for the month, for the building that you own, you've paid all of it for 1 year. So it's all prepaid, okay? Not week to week, but for the entire year. So it's prepaid, right? Because you actually use it. Insurance, if you think of insurance for those that have cars or house insurance, it's a lump sum. So you pay it for the entire year. So you still have that. It's an asset that you own because you prepaid for it and you have that insurance. Land, so you actually own land. So maybe you own some property, the property that the business is on. So that's something that, right, you own. All these things are things that you could liquidate that have value to it, if you think of it that way. So an automobile, right? That is something you owe. You may not own all of it because you have car payments, but you own a portion of it, right? So that falls under that category. If it's 100 paid out outright, then that number would obviously be a lot more, right? So automobile, and this is where we get into the balance of it, right? Buildings, do you own any buildings? Absolutely. Furniture that are in the business, do you own that? Yes. You went to Staples or Walmart, whatever, and you bought furniture, so it is owned by the company. Inventory, if you're selling soccer balls or bicycles, right? You pay for them from the vendor. You pay it outright, so you own them all together. That inventory falls under that category, right? So all the things that you own, okay? Also, as we get into further accounts and move on to further videos, we'll talk about PPE, which basically is, if you think about it, it stands for property, plant, and equipment, and it's just a fancy word saying it kind of summarizes all these, like, so lands, right, property, plants with business plants like office plants, So it's actual building itself. Any equipment, so vehicle, furniture, all that kind of stuff would fall under equipment. So all that stuff can be summarized quickly into that, because you don't want to have a huge list, because you can have so many things that fall into different accounts. So to simplify it a little bit better, they just talk about PPE. It narrows it down and makes it a lot easier, right? Because we don't want to have to, okay, so we own pens, and then we own mice, and we all that kind of stuff, right? So that's something that they make to make life a little bit easier, okay? So again, on the balance sheet, so assets equals liabilities plus the owner's equity, right? And where do we get the owner's equity? From the statement of owner's equity. All right, let's look at the liabilities. So the first liability, right? So things the company owes, right? So number one thing that usually people owe is things, a bank loan, right? Or a loan from somebody. So 90% of the time it comes from the bank, right? So bank loan is usually key right there. The next one, which is always sometimes confused with AR, is AP, right? They get balanced. So think about it. So accounts payable is what AP stands for, and it's how much the company owes to a vendor. So for example, I own a bicycle shop, and I don't have the money right now to when I buy the bikes from a vendor. So I would place the order, but I haven't paid for it yet, right? I haven't gone to the bank, or I just placed the order, but now I'm committed to that invoice. So I have to pay it. I just haven't paid it yet. So that would be accounts payable, okay? Salary payable, right? Companies own to employees. So if you hire someone to do a baseball tournament, you hired the umpires, but they haven't completed the job yet, but you know you're going to have to pay them, right? So that's salary payable. So you pay employees or people that you've contracted to, but you haven't paid them yet, but you've already committed to them. Another one, unearned revenue, okay? So this is another key one. This comes up a lot. It gets really confusing sometimes. Unearned revenue, so company that was paid for a job but hasn't done yet. So for example, if you go in to get your vehicle washed, you pay for it first, right? But it hasn't happened yet. So you haven't been paid. The company was paid for the job, but it hasn't been done yet. We haven't done that job yet, right? So we were paid for it, but we still have to do the job. So that's important. So it's unearned revenue. So we've received the revenue, but we still have to do the job. So it's unearned revenue, not revenue. Even though we physically have the cash in hand, we haven't done the job, right? Because if something happens and say we can't do the job, what's going to happen? Well, that company is going to want the money back. So it's a liability. So we don't, even though we physically have it, we still don't legally have it because we haven't completed the job. If you ever they ever took us to court, they haven't, we took $30,000 to do a basement renovation, and we decided just to bugger off and not do it. We're going to have to owe that money back. So, right? So it's unearned revenue. All right. Mortgage payable, right? So if we own a mortgage with the bank, so that would be something as well. So we owe money for the mortgage. So that would be another account that comes up occasionally, if you'll see it come up. So again, assets equals liabilities plus owner's equity. And where do we get owner's equity? From the statement of owner's equity financial statement. Okay, let's move on. All right, so that's it. That's the 3 financial statements. Just quick recap. I throw a little curveball here. I want to see if you catch it. But the first one, income statement, right, is revenue minus expenses, right? How much income? And that is either a positive, which would be a net income, or a negative, it was a net loss if we've lost money, right? All right, moving on to the statement of owner's equity. So we have OC, right? Opening capital, right? If there is nothing mentioned, we assume opening capital is 0. Remember that? Plus I, plus NI. Wait a second. We didn't talk about I. I is the same as C, is capital, right? Because capital is what was invested into the company. So I is the same as C, but I just want it could be written either way, but it's capital, right? What we invested that month. That's why I kind of put the I there. I like using that just as a little trick, right? So opening capital plus capital or invested, right? How much you invested into the company, plus net income. And if there is a net income, is there going to be a net loss? No, you can't have both, right? It's one or the other. That's why it's important to keep it using this formula. And D, what does the D stand for? Drawings, right? Could be also written with a W, withdrawals, right? So when you're taking money out for personal use, right? We're withdrawing money for personal use. Remember, buy your kids a new bike, all right? So, and that gives you your ending owner's equity. And last but not least is the balance sheet, right? When we're comparing our assets versus our liabilities. Assets equals liabilities plus owner's equity, and that will give you how much you actually have or how much you own for the company, right? Don't want to get terminology. So how much you own, right? Assets are how much you own versus how much you owe for liabilities, right? Plus the owner's equity, because that gets it put into the company. All right. That's it for today, guys. Again, keynote takeaways, right? Read the chapters first. Don't jump right into tutorials as much as we'd like to, because you will struggle. And if you need help, please take screenshots specifically, because remember I said they change from student to student to student, what numbers and the terminology they use that we just kind of went through those accounts. So I hope that helps. Again, if you have any questions, shoot me an email, and we'll see you next week. And if not, yeah, we'll see you next week.